Good news is emerging in the realm of Social Security benefits. Lawmakers are actively discussing the potential for increasing these benefits. Today, we will delve into the specifics of these discussions and explore why these changes could be advantageous to you. If you are currently receiving Social Security benefits, understand that these proposed changes could impact you. Likewise, if you are contemplating collecting Social Security benefits in the next 5, 10, or 20 years, these discussions are of relevance to you. Before we dive into the details of the new bills and why they are under consideration, it's essential to acknowledge that this topic has been on the legislative table for over a decade. Every year, lawmakers rally supporters and propose new bills, but they have yet to pass. As we explore the content of these bills, you will understand some of the reasons behind this long-standing debate. There are two bills on the table, one introduced by Republicans and the other by Democrats. The fact that there are two nearly identical bills, one from each party, underscores the complexities of passing such legislation. Let's take a closer look at each of these bills. The first bill, introduced by Republicans, is titled the Eliminate Social Security Double Tax. This proposal aims to eliminate the tax that beneficiaries pay on their Social Security benefits. However, it's important to note that this bill does not introduce new funding sources. According to reports, this could potentially increase our national deficit. This creates a dilemma as Republicans typically advocate for reduced spending, yet this bill would reduce revenue without additional funding sources. On the other hand, the Democratic bill, known as the You Earned It, You Keep It Act, takes a slightly different approach. While it also seeks to eliminate the double tax, it proposes to increase revenue by raising the payroll tax cap beyond $161,200 per year. This increase in revenue would offset the loss from eliminating the tax on benefits. Now let's explore how these bills might affect you. The goal is to ensure that your provisional income is reduced to zero. If your provisional income on your tax return is zero, it means you would not owe any taxes on your Social Security benefits. But how is provisional income calculated? Here's a brief overview. Provisional income, PI, consists of three components. 1. Gross income. 2. Tax-exempt interest, or income. 3. 50% of your Social Security benefit. To determine whether you owe taxes on your benefits, your provisional income is crucial. The tax thresholds differ for single filers and married individuals. For single filers, if your provisional income is $25,000 or less, you owe 0% in taxes on your benefits. If it falls between $25,000 and $34,000, you owe taxes on 50% of your benefits. Above $34,000, 85% of your benefits become taxable. Let's illustrate this with an example. Suppose you are single and earn $30,000. Your provisional income is right between the 50% and 85% thresholds. So you would owe taxes on 50% of your Social Security benefits, not the full $30,000. Understanding these thresholds is crucial in determining your tax liability. For married individuals, the thresholds are different. If your provisional income is $32,000 or less, you owe 0% in taxes on your benefits. Between $32,000 and $44,000, 50% of your benefits are taxable. Beyond $44,000, 85% of your benefits become taxable. To complicate matters, the federal income tax brackets for 2023 based on your overall income also come into play. These tax brackets have their own calculations and rates. It's this intersection of Social Security benefit taxation and general income taxation that can be confusing. Returning to the bills, it's important to note that as they stand, they are unlikely to pass in their current forms. One bill seeks to increase the Social Security payroll tax cap, which goes against the promise not to raise taxes for those earning under $400,000 per year. The other bill, while eliminating the tax, might contribute to the national deficit. However, these bills could serve as starting points for further discussions aimed at securing Social Security's future while ensuring beneficiaries receive their full benefits. In summary, while these bills offer potential savings and benefits, the intricacies of Social Security taxation make this a complex issue. If you have questions or seek clarification, please feel free to ask in the comments below. Thank you for watching and consider subscribing for more updates on this important topic.